And here we go. Good morning, good afternoon, good evening, everyone. Thank you for joining Preventable Surprises' fourth masterclass, featuring John Lukomnik, who insists on being introduced as a person who's having his birthday today, as well as having an incredible batting average for the Yankees. I know nothing about baseball, so I trust that this is something significant. Welcome, John. Thank you for making time for everyone today and for this masterclass. Preventable Surprises sparks and facilitates difficult conversations in ESG and sustainability and finance. One of the things that we've been doing since last year is hosting masterclasses, which is really fundamentally about having an interesting question and having somebody that has an interesting answer or set of answers or set of follow-on questions, and me asking them if they would share that with a larger audience. Today's conversation stems from me speaking with John and saying, but how do boards work? What do we really know as investors, as active investors in corporate governance and ESG and shareholder activism? We have a lot of ideas about what we should do with board directors, but what do we really know? And this is the background for today's presentation. I will share a few links in the chats, one to the YouTube channels where I've hosted some of the past conversations, another one to our donation page. This presentation is entirely free of charge, but it also doesn't come without costs, as does a nonprofit, so always welcome support, and we welcome those that have made donations. We thank those who have made donations for this in relation to this event. I will stop here, and hopefully you will not hear from me until I raise more questions, or I'll raise your questions in this conversation later in the chat. John, thank you. Happy birthday.
Thank you. Shall I start?
Go ahead.
Okay, can we have the next slide, please? So, researching today's talk about why investors, corporate officers, and board members differ in how they think about corporate governance took me down a number of fascinating rabbit holes. For instance, the structural reasons I'm about to discuss rely heavily on the idea that we're all empiricists. Del Minno, who just sent me birthday wishes through the chat, mentioned this at a recent Council of Institutional Investors meeting. What I mean by that is that our humanness influences how we perceive reality, changes how we process facts and context, and therefore changes our analyses of what we should do. For example, I could start, since we're all talking about my birthday, today's talk by thanking Jerome and Preventable Surprises for inviting me to talk with you all and tell the story of how we were having an enjoyable catch-up lunch a few months ago when the subject came up, and he gave me the opportunity to refine my thoughts. I was so enthralled by the subject that I thought that doing the class would be a great way to celebrate my birthday. Or I could express my frustration that a casual, no-pressure lunch was weaponized, forcing me to spend days fleshing out those ideas. And now I'm spending my birthday talking about them. The truth, of course, is the first, at least as I perceive it. But in other words, despite the famous line from the old television show Dragnet, just the facts, ma'am, facts are never just facts. We are human. Emotion, context, incentives, peer reaction, and a whole host of things affect how you regard the facts. Empiricism challenges rationalism by saying that lived experience affects how we regard the same set of facts and challenges. We're also saying that we reject that there is an ex-ante universal logic to reality. Now, for what it's worth, and clearly the four philosophers I mentioned here are way above my IQ level, but for what it's worth, my personal belief is that both empiricism and rationalism have value, and which way you lean is a product both of the observer and the observed. I am much more inclined to be rationalist about science and math, and empiricist about my interaction with other humans and social constructs. And that includes markets and corporate governance, which, as innumerable academics have noted, are social constructs. Wow, that certainly was a rabbit hole. So what does this have to do with understanding why investors, corporate officers, and board members think about corporate governance differently? Why am I making all of you have flashbacks to your first year college review course about Western philosophy in week 5? There is, of course, a simple answer. If the lived experience, the incentives, the goals, and the context affect how we all think about reality, then it makes sense that investors, corporate executives, and board members would view corporate governance differently. Simply put, where you sit on the investor side or on the corporate side will affect where you stand on the issues. Indeed, we're all going to view facts and circumstances differently. But that's not much of an insight for a masterclass, is it? So consider it just the prerequisite to the main event. What's interesting to me is that the differences in how investors, corporate officers, and board members view corporate governance issues are structural and underexamined. That, in turn, means they will cause foreseeable issues. The result, to appropriate an appropriate phrase, are preventable surprises. Next slide, please. A brief semantic pause before I outline the causes. It's awkward to continuously use the phrase corporate officers and board members, so I'll use the phrase corporates. I find referring to people as corporates to be a little general and honestly a little dehumanizing. Contrary to the Supreme Court in the Citizens United case, I don't think corporations are people. And it conflates executives and non-executive directors, but it's the best I can think of and has the advantage of being common usage. So I apologize in advance for deciding to use it. With that, let's get started. Here are 4 structural reasons why investors and corporates view corporate governance differently. First, investors tend to see risk and return through the lens of markets and portfolios. Corporates generally see risk and return through the lens of their singular company. The second reason is similar to the first. Investors worry about the snowstorm, meaning they want universal minimum standards across all companies in a marketplace so as to prevent what we see as a race to the bottom. Corporates want their company to be treated like a singular snowflake, with investors understanding all the differences between their company and the others, and making exceptions to those universal standards where such an exception would, in the corporate's opinion, benefit the company. The third reason actually has a Nobel Prize theory behind it. Behavioral finance, like empiricism, says that people are not entirely rational. When you apply prospect theory, behavioral finance's crowning theorem, to executive compensation, you get some very interesting conclusions. And finally, time frames and risk tolerances vary by investors and investor types. That can send mixed messages to corporates. Let's delve into those 4 issues one by one. Next slide, please, Jerome. So, talking about portfolio versus individual company risk and return, we say that both investors and corporates have the same financial goal, at least at a high level of conception, to reap the best risk-adjusted return. We say risk-adjusted return so often that we fail to really think about what that means. It could be either the least risk for a unit of return, or, as I'd like to define it for this purpose, the most return per unit of risk. And we tend to think about it ex ante because ex post, you know what it was. Ex post, you can pick a single stock portfolio, just pick the one that performed best in the past year, and then change the one that performed best in the next past year. Ex ante, it's a little harder. So here's the issue. Those of you who have read Moving Beyond Modern Portfolio Theory, or have heard me or anyone else talk about systems level or universal ownership theory in the past few years, probably have this statistic tattooed onto your synapses. Security selection and portfolio construction for a diversified investor, they only account for 6 to 25% of the variability in your return. That's the contribution of idiosyncratic risk, company X versus company Y, to diversified investors' risk and return, just 6 to 25%. The rest, the vast majority, is attributable to non-diversifiable or systematic risk, such as the general price level of capital markets. All of you who are invested in the markets through a diversified portfolio understand that intuitively at this point. It was hard to lose money from 2010 to 2021, and it was hard to make money in 2022. Importantly, I note that this is a change in the past 50 years. Virtually every investor today is diversified. We invest through index funds, mutual funds, ETFs. Even active managers in a single account own at least 40 or 50 securities, and often 80 to 120. But think about this in contrast to the corporates. All there is idiosyncratic risk. They are concerned with one company. Now, that's not entirely true. The general state of the markets, the systematic risks of the market also affect the market price and therefore cost of capital of an individual company. But the level of idiosyncratic risk in a one company portfolio, which is what a corporate has, is clearly much higher than that of a diversified investor. A corporate perceives it to be close to 100%. Now, there is one other concept to consider before we think about the impact on corporate governance of this difference between a portfolio perspective on the one hand and a singular company perspective on the other. We often talk about value and risk in the marketplace. But by and large, value and risk are created in the real world, not in the marketplace. They are priced in the capital markets. In other words, the capital markets are dependent on the health or not of the real world social, financial, and environmental systems. There are some major causes of non-diversifiable systematic risk. It's actually a bit more complicated because there are feedback loops between the capital markets and the financial, social, and environmental systems. And this could be a whole other rabbit hole pretty quickly. In fact, I find it so interesting that that's what my last book was about, but it's not today's topic. So let's leave it there. Still, we have one, the portfolio versus the company issue, and two, the idea of value and risk being created in the real world, but priced in the capital markets. What do those two concepts mean in practicality for corporate governance? The primary area it affects are externalities, the costs or benefits that are created by a company, but which are not recorded on its financial statements because of standard accounting rules. And I note that externalities can be positive or negative. I'm going to focus on negative externalities briefly, rather than the positive ones, because in some ways, positive externalities, such as advances in technology or medicine, are win-win situations for both investors and corporates. They have salutary impacts on the environmental, social, or financial systems. And realistically, no one is complaining about them in general. What they complain about sometimes is reinternalization, such as the cost of medicine and availability of medicine. But generally, positive externalities are not the focus. By contrast, diversified investors are concerned with negative externalities, such as greenhouse gas emissions, precisely because the risk to those environmental system affects the value of the entire portfolio. Climate change is the consensus systemic risk causing systematic, well, let me put it this way, climate change is the consensus systemic risk in the real world, causing systematic, meaning non-diversifiable risk in the capital markets, but there are others. Next slide, please. Recently, for example, the shareholder commons and disclosure, I am on the board of TSC, sued the board of directors of Meta, otherwise known as Facebook, arguing that Facebook caused harm to its diversified shareholders by fomenting social unrest. I am not going to comment on the substantive aspects of the suit, but I find the initial pleadings fascinating because when you leave aside the substantive specifics of the complaint, the legal arguments are cutting edge on both sides. And they illustrate this disconnect between maximizing risk return in the real world for diversified investors versus maximizing risk return in the real world for one company. As Rick Alexander, the CEO of the Shareholder Commons, puts it, Meta's response, quote, asserts that executives cannot separately consider the harm they might be imposing on their own shareholders by degrading systems important to the economy, end quote. I have no opinion on the legal accuracy of the Shareholder Commons or Meta's pleadings, but I do believe that what Meta's lawyers argue is the dominant belief in America's boardrooms and among corporate counsel. Their fiduciary obligation is to maximize the profitability of the individual company. That said, the legal argument doesn't reverse the economic imperative of diversified investors to try to mitigate systems risk in the real world. So you have a conflict. It may, in fact, simply reflect a legal standard that was put into place at a time before this explosion in prepackaged diversified investment products. And the seminal cases of fiduciary obligation by a corporate board were argued and decided certainly before the theory of systems level investing was written, which only dates back a few years, or even of universal ownership, which dates back only about a quarter of a century. Let me digress briefly. This is a shallow depression, not another rabbit hole, to tell you a story that illustrates how different the viewpoints are of diversified investors and corporates. At the end of proxy season last year, I was on a Zoom when a very well-respected corporate governance expert gave her succinct summation of a number of shareholder proposals last year, and they expressed views similar to those in Meta's lawsuit. Would you please curb externalities so that your diversified shareholders can benefit? She said, and she was talking to a bunch of portfolio managers, she said simply, these are crazy. They don't want a company to make as much money as it can. To return to the Meta case, I'm not a lawyer, so I can't either practice or malpractice. So if I'm not going to opine on these substantive arguments, and I'm not going to apply the law, why do I mention? Because the complaint in the pleadings, as well as that corporate governance expert's reaction that tried to maximize portfolio return, was crazy as compared to maximizing individual corporate return, clearly indicate the structural gap between diversified investors and corporates. Simply put, those differing viewpoints are structural and imply very different corporate governance views because each are trying to maximize a different source of revenue in the real world. Different source of value in the real world. As a result, they are predictable and should not be surprising, but we sometimes think they are because we tend to use the same words like maximize value to mean totally different things. Next slide, please. The same many versus one viewpoint is at the heart of the snowstorm versus snowflake dichotomy, but it manifests differently. In general, diversified investors, and particularly those who specialize in stewardship and corporate governance issues, have, in many corporate governance issues, decided on uniform standards that we, I will include myself in this, wish to see across the market. Investors have for years used the precepts of systems level investing and applied them to corporate governance even before we enunciated the theory. Investors were trying to protect themselves from a snowstorm of substandard governance practices. Some of these are settled issues. For instance, confidential voting. When I started out, there was no such thing. Some are settled in some jurisdictions, but not in others. For instance, should the CEO and chair be split? It's largely settled in one way in the UK and very unsettled, or perhaps even settled in the other direction in the US. Others seem to be evolving strongly in one direction, but haven't yet become absolutely standard. For example, we have seen a massive destaggering of boards in the United States, a decrease in plurality voting for directors, an increase in gender diversity on board, and coalition around virtually totally independent boards where only the CEO, or perhaps the CEO, and one other executive officer sits on the board of large US companies. I will tell you it is not quite standard, any of those, on smaller cap US companies. We investors think these protections serve us across the marketplace. But a common complaint of corporates are that the standards may be generally appropriate, but are not applicable or optimal for their particular company. They're not trying to protect from a snowstorm, but pointing out that their particular company has unique features and that one-size-fits-all standards may not be optimal. They say their particular snowflake is unique and should therefore be treated and protected as such, lest it start to melt and lose what makes it a particular company. The most visual collision between investors trying to protect against the snowstorm and corporates trying to protect the snowflake is around the single class versus multi-class shared debate, particularly when it comes to the role of founders. Some corporates, particularly those which are recent technology IPOs, argue that the founder's vision is the secret sauce that makes their company unique. I am not endorsing that viewpoint, merely pointing it out. It is a snowflake viewpoint. There are other debates as well. The weird different argument from corporates is heard so often around executive compensation negotiations, and it's one reason that corporates are so bitter about the role of proxy voting agencies in enforcing universal standards. Indeed, while corporates often craft their executive compensation programs to fit within the market standards as codified by ISS and Glass Lewis, and I should say ISS and Glass Lewis in doing that are reflecting we institutional investors and what we want, not single-handedly proposing standards. If you ask enough corporates, you'll hear that they try to make their executive compensation fit within the ISS and Glass Lewis standards, not because they agree that the standard should apply to their unique situation, but they've recognized the standards as force majeure. They still are very angry about it. And I'm not saying this either to protect against the snowstorm or the uniqueness of the snowflake argument is correct, just that again, there's a structural difference in the basis for investor or corporate beliefs. Some of these bases are not positive. Corporates, in making the snowflake argument, suffer from what behavioralists call familiarity bias. The comfort they have with the familiar causes them to overstate the benefits of their current situation. They just can't conceive it another way. On the other hand, standard enforcing investors sometimes do try to force round pegs into square holes, like a rationalist philosopher. Sometimes the uniqueness of a governance structure makes sense. My belief, based solely on my lived experience, a very empiricist viewpoint, is that those situations are far rarer than the corporates who make the argument, but they're also more than zero. Finally, I note that investors don't know what goes on in a boardroom or C-suite. We only know either what's disclosed or what we can infer from performance. In terms of timing, both of those methods of discovering information are ex post. Corporates, on the other hand, know based on personal experience. And they deal with corporate governance issues in real time or even ex ante. So protecting from the snowstorm or protecting the snowflake relies on knowledge, the facts on which we base our opinion as to the appropriateness of various corporate governance structures, but also the time frame of the facts and the analyses on which we are making those judgments are different. Next slide, please. Let's move on to executive compensation. This is a diagram of what is perhaps behavioral finance's most famous theory. Prospect theory says, among other things, that people are not economically rational. We don't value upside and downside, risk and opportunity evenly. Rather, we feel loss much more than gain. In fact, as the chart shows, the average person dislikes an increment of loss more than 2 times an increment of gain. Measured against what? Well, people measure it against what's called a reference point, often the price at which something was acquired. That is why charting is done in stocks, or the status quo, for instance, last year's compensation. I'm sure you can see where this is heading. Next slide, please. About 30 years ago, we investors, and I'll use the phrase we here because I was one of them, endorsed the idea of paying first corporate executives and then corporate board members in stock or equity-linked compensation, such as options. The idea was that it would align the interest of investors and corporates. I will leave it to the people watching this masterclass as to whether or not that idea belongs in a place of honor in the Museum of Unintended Consequences. Had we paid attention to prospect theory, we might have not been so glib in asserting alignment. For instance, being loss adverse may encourage executives to try to achieve easily achieved short-term targets, such as quarterly earnings, rather than take more risk that might be better long-term because they want to maximize the pain felt from loss short-term. This obviously can contribute to short-term. For instance, if the way to make a quarterly number is to cut R&D or brand building, which may degrade a company's long-term growth potential, to compensate for the generic loss felt twice as powerfully as gain, a compensation committee of a board would have to make the upside compensation potential at least twice as great as the loss potential. Also, investors and corporates usually have different reference points on that S-curve. The reference point is that point in the middle of the last slide for which gain or loss was measured. For investors, the reference point is usually the price at which the security was bought, or perhaps the current price. For corporates, however, the reference point is not as obvious. But in general, because equity-linked compensation is granted and is going to be granted year after year, the executive tends to perceive each unit of compensation as lower on a curve than would an investor who purchases. Therefore, the downside-upside mismatch is amplified, suggesting that for any point in time, a corporate official would need a disproportionate upside exposure to equal an external investor's sensitivity. Now, I note that comparing utility values across people is notoriously difficult. But theoretically and on average, that's true. It does, however, change over time. For instance, if a CEO gets $1 million in compensation in year 1, that likely would be the reference point for year 2, and the disproportionate upside would begin at $1 million. If, however, he, she, they receive compensation of $2 million for year 2, that CEO's reference point shifts to $2 million. So the disproportionate upside exposure needed to motivate that CEO would begin at $2 million and so on. Let's do a scenario analysis that combines both those points. A CEO gets a large out-of-the-money grant because the comp committee thinks that's the way to overcome the CEO's loss aversion. We, as investors, are glad when in fact it works and the company hits those aggressive numbers. But then the CEO's reference point ratchets up and the same dynamic applies. Now, the traditional explanation for the ratcheting upwards of executive compensation is that it's largely a result of boards wanting to pay the top half of peer groups. But I have to think that the resetting of the reference point and trying to set incentives that motivate CEOs also has an effect. Next slide, please. My fourth and final point is also structural, but to be honest, it results in a less predictable set of differences because the structural mismatches between investors and corporates are multidimensional, multi-directional, and variable. Time frame and risk appetite are essential inputs for any corporate strategic plan and for an investor's portfolio. But we tend to oversimplify the complexity of figuring out investor and corporate time frame and risk appetite. They're different, but exceptionally heterogeneous. And those differences and heterogeneity underlie some major corporate governance issues. For example, investors, particularly pension funds and those who think of themselves as universal owners, such as index funds, often say they're long-term investors. And we sometimes complain that corporates are overly short-term. But they're not the only investors. Consider the case of former Danone CEO Emanuel Faber. Faber was famous for his commitment to ESG issues and long-termism. He even led the effort to convert Danone to a B Corp in 2017. That long-term vision of long-term sustainability, long-term profitability, and improving the systems on which Danone relied was often lauded by commentators, investors, and even governments. But it wasn't popular with other investors who wanted increased short-term profitability. This story doesn't have a happy ending. Faber was forced to resign in 2021 over short-term profitability concerns. On the corporate side, most strategic plans extend out 5 years. But only 10% of the S&P 1500 companies have compensation plans that extend more than 3 years. And most boards, thanks to the previously mentioned effort to be staggering them, are elected annually. So there are a multiplicity of timeframes in work. A company under pressure from an activist or otherwise may care about a board election in a few months. The CEO of the same company, under no such pressure, may want to maximize his payout under a 3-year plan, but perhaps the strategic plan needs to sacrifice returns for 3 years for a larger payout in years 4, 5, and beyond. Ideally, the compensation committee could change the times and change the targets for the strategic plan, but not if the longest long-term incentive plan is just 3 years. And a CEO may worry about suffering the same fate as Monsieur Faber. Let's add another complication. One of the most important things a strategic plan does is suggest what resources the corporation wants to commit for what level of potential return and what level of risk. That's the risk appetite. At least in theory, the strategic planning exercise should unify a corporate board and executive management around that specific risk appetite. What resources are acceptable to be put at risk to achieve a strategic goal? But what if a corporate board wanted to consider the risk appetite of its investors? Are the investors the bank or fixed income investors who are happy with a cash flow positive, low risk posture that virtually guarantees they get their loans repaid with little drama, but also little growth for the company? Is it an active equity investor who would like some extra leverage in the capital structure to increase return or to take advantage of a corporate opportunity? Is it a balance sheet hedge fund which wants the company to recapitalize with lots of leverage so as to goose return on equity, even at the risk the company may not be able to repay the loans when they come due? To quote the 2009 Meryl Streep movie, it's complicated. With heterogeneous investor and corporate timeframes and risk appetites all over the place, the odds of misalignment increase. Add that little bit of spicy complexity to the issues we've discussed previously, the focus by investors on portfolios compared to companies and corporates focusing on an individual company, the desire of investors for standards so as to avoid the snowstorm, while corporates want to cater to the individuality of the snowflake on which they live, the effect of prospect theory on executive compensation. And it's clear why even well-intentioned and informed investors and corporates sometimes have different takes on what good corporate governance looks like. Let me return to where I started. If we're all empiricists, that is, if our surroundings and lived experience affect our ideas to what is reality, then it's not a surprise that structurally different situations, asymmetric knowledge, differing timeframes and risk appetites would result in different conclusions by investors and corporates. Where we get into trouble is when we approach corporate governance as rationalists, acting as if there is an inherently rational structure to reality that everyone can deduce. That in turn suggests there's one true answer out there. But there isn't. And I know that's not a satisfying answer. As an investor, I have for years suggested that the investor view is correct. But I like to think that I'm rational enough, not rationalist enough, but rational enough to recognize that sometimes where you stand on these issues depends on where you sit. I hope that by understanding the structural differences, we're able to negotiate through and reach better solutions. Yes, there's a danger that understanding the other side's position, no matter which side you're on, will open the door to someone taking advantage of you. But there's a bigger risk, and that is not working together as investors and corporates to improve our companies and economy and society as a whole, simply because we don't understand each other. Pretending that my empiricist view of the world, informed as it is by a focus on a portfolio, focused on preventing the snowstorm, and trying to get the balance of incentives correct, according to prospect theory, is always correct, is comforting to me, but wrong. And that's not helpful. Thanks very much for listening. I know some of this, in retrospect, now sounds obvious, but I hope it's obvious the way the conclusion to a mystery was obvious to Watson after Sherlock Holmes had stated what was indeed obvious, but only in retrospect. As Holmes's creator Arthur Conan Doyle once said, the world is full of obvious things which nobody by any chance ever observes. So I hope the rabbit holes I went down sparked some obvious thoughts that, despite their obviousness, will be helpful to you. And Jerome, as I think you can infer, I really was happy to think about these issues and do this talk. My thanks to you and Preventable Surprises for inviting me. I'd be glad to take questions, or looking at the list of people attending, just listen to this really impressive group of attendees discuss the issues. Thank you.
Thank you, John. This is amazing. I have been following you down the rabbit holes, and it will be a while until I come out of them. So let me start maybe with some of the questions that have come through in the chat, which I found all the more interesting since they were not the questions I was necessarily thinking about. Here's one. This is a fascinating masterclass. Thank you, John, for highlighting the gap between investors and corporates and why they exist. Curious if you've given any thoughts to things that might reduce or mitigate this gap. And if you have, would love to hear what you are thinking about.
I tried to get there in the end, which is first by trying to understand what whomever you're negotiating with, not what they're thinking, but what their incentives and their context and their framework for thinking of it is. And every once in a while, understanding it. I will give you an example. There is a Fortune 500 medical dental product distribution company that generally is regarded as among the best in class. It has, in my point of view, an absurdly large board. I think it's 14. I believe they have 4 or 5 insiders on the board. So totally non-standard board structure. We're not even getting into contentious things like executive compensation. We're just talking about board structure. For the United States, that is, they are an outlier. I sat down with the CEO and went through all the reasons that I had a problem with it. He actually convinced me that in their situation, it was right. His answer was the independent directors are allowed to wander around and talk to whoever they want the company. That by having relationships with the other four inside executive directors, they were able to speak to them away from the boardroom as well as at the boardroom. And that too often when you only have one executive, the executive can control all the information, and that this way, if there was other information that needed to get to the board, the others would work. He said, it doesn't work if you have a CEO who is domineering, can control the other executives by either force of personality or threat or executive compensation. But if you actually have a team that came up together so that everyone is paid almost equally and everyone understands what their role is, he thinks it creates a better boardroom dynamic. I don't think that company has ever gotten a request to change its board structure, because all the active managers, hedge funds, and everyone else who looks at it have so far agreed with that CEO. Now, what will happen, generational change when that CEO leaves, I don't know. But at the moment, I'm willing to grant them snowflake status.
Thanks, John. Here's a comment and a question that could have been part of the first question in some ways, but maybe opens other doors. Terrific presentation reflecting a deep think into a vital topic. One additional structural real-world distinction is that few investor stewardship professionals have ever served as an exec in public companies, so they have little insight into everyday corporate thinking. Equally, few corporate board members and fewer corporate executives have ever served in an investor stewardship capacity, so they have inadequate antenna for understanding what it takes to prevent a snowstorm. Is there a way to bridge this cultural gap?
I think there is both an experiential cultural gap, as that questioner asked, but also a knowledge gap. It's hard to bridge the cultural gap because if you've sat in one seat for a while, you tend to absorb by osmosis that culture. But for instance, right now, the hardest two jobs to hire on the asset manager, asset owner side are ESG analysts, stewards, and data scientists. There's a running joke that, what's the fastest thing in the real world? It's faster than a cheetah. It's even faster than the speed of sound, faster than the speed of light is an instant ESG analyst, right? And I find that too many don't actually understand corporate finance. I will be the first to admit I can't calculate a scope 3 emission, and despite having taken the GRI course. But I think that if you're trying to understand why a corporation does something, you have to understand corporate finance. So the first thing I would say is stewardship professionals, in addition to needing to know the standards and what their institution is trying to do and why, need to have at least a introductory knowledge of corporate finance, and surprisingly many don't. I think there are other ways to bridge the gap. TIAA-CREF famously hired ex-CEOs to be their stewardship team at one point. So that is a different possibility. On the corporate side, I will give you the same answer I have always given the corporates, and some of them do it. Go where these issues are being discussed amongst investors before you have a need to. So, for instance, attend the Council of Institutional Investors. go to the meeting, if there is one at the University of Delaware, of the Investor Stewardship Group. Go to the International Corporate Governance Network. Pay attention so that when you have a question, you have someone you can ask. I mean, it is interesting to me how I note the people, I see the people who are the participants. And if I said to these people, name, which companies get it right, we're going to hear about Peggy Ferran at Prudential and Coca-Cola, and maybe when Doug Chow was there, Johnson & Johnson. And the fact that we can name them is really interesting, because they were and are the people who go out of their way to understand the issues from the snowstorm point of view by attending and understanding what is of concern to investors.
Thank you, John. There's more questions. I'm not taking them in order because I'm trying to weave them into a logical sequence here. But on this last point, one question is, do you think having more individuals with investment backgrounds on boards, or even better, more individuals with ESG stewardship investment backgrounds and with previous experience at a diversified investor sitting on boards, could help improve the snowflake-snowstorm dynamic?
There actually are a lot of people with investment experience on boards. They tend, however, to be people with private equity investment experience, which is a whole other cultural issue. I think what I would suggest is, most corporations have an entire department called investor relations. Some invest, and they are supposed to be informing not just the CFO and the CEO, but boards. Too many of them focus on short-term stock price bumps. Part of that may be the structure of the executive compensation, but whatever. There are many fewer IR professionals who understand the governance issues. That is often left to the corporate secretary. I think that one way, I'm loath to suggest that boards have any one specific criteria for being on them, because board seats are limited, and I don't know what business the board is in or what the gaps of the board are. So while I think I am sympathetic to the question, because I think investing experience is undercounted or undercredited by the executive search firms, and there should be more. I think what every company can do is have their IR person and their corporate secretary cross-fertilize each other's knowledge. Have the IR person go to the American Society of Corporate Secretaries and Governance Professionals, have both of them go to a CII meeting, have their corporate secretary go to the IR meetings. It would be very helpful so that people understand not just the supply-demand side of investor relations, but the fact that when you buy a share of stock, you actually own a voting interest and a governance interest in the company.
Here's another one. Superb as always, John. I'm sharing all the compliments too. Do you think universal proxy or any other evolving governance initiatives will create a stronger connection or more effective communication between investors and outside board members?
I've heard a lot of different views about universal proxy, and this is not an area of my expertise, so I will just say most people think it will be helpful. Some think there will be unintended consequences. I think the biggest thing that has helped is, 10 years ago, if you asked to speak to a director, you were funneled back to the CEO or the IR officer. Now, if you have an executive comp question, you are pretty much guaranteed to talk to the chair of the executive comp committee. If you have a governance question, to governance, et cetera, to NomGov. So I do think actually face-to-face helps. I think that by the time you get to a universal proxy, it's probably too late because that means you're in a contested situation. All the back and forth will be lawyered up and run through proxy solicitors and designed to achieve something. It would be nice to think that we can improve that comprehension uh, before getting there. Um, so I think that the the biggest thing would be more face to face. And by the way, in that group of people that talk face to face, I should say the National Association of Corporate Directors in the US and the ICD in Canada. It would be nice. They do outreach now to institutional investors. I think they should do more. The other thing is certainly for large cap companies, their audit firms and their and the consulting firms of the big four, big six, where they're not auditing, often provide some level of research into what the trends are in corporate governance. I would think that they should expand that to also perhaps have some small format 30-person type thing where the under the auspices of the accounting firms and the consulting firms, they bring together a small number of committee chairs, outside independent directors, and investors to discuss what's behind those trends. I want to be fair here, though. The reality is most institutional investors don't get paid for that. And I will tell you, there's one very well-known, well-respected stewardship head at a very large firm who said, I get these calls and it's, hi, this is company XYZ. We'd love to schedule something to come in and talk to you about. So, oh, okay. What do you want to talk about? Oh, we just want to get to know you. And she doesn't have time for 3,000 individual meetings, right? Which is why I say going to these events and gatherings where the investors already are, meeting investors where they are, is sometimes much more helpful for corporates than trying to schedule a meeting. Yes, most of the corporates now meet with their top 10 or 15 or 20 investors, but sometimes those top 15 or 20 are not the ones who are driving what the standard setting agenda for investors is.
Thanks, John. There's many questions coming, and we have about 7 minutes left in official time. We could all try to reconnect afterwards to continue, but I'm going to try and condense some of them now. So let me ask a few in succession, and forgive me, attendees, if I misrepresent or change your words by mistake. One general question is, well, given how you frame this cultural gap between boards and investors, and if we're trying to address or to solve problems here, should we focus more on issues, or specific issues like climate change or climate risk or executive compensation, or should we be focusing on those incentives and the challenges and the gaps like time horizons or the snowstorm or snowflake point of view? So that's one. Then there's a few questions.
I can answer that one quickly, one sentence.
Yeah.
The issues are your goals. Understanding the incentives are your tools. Unless your goal is to change the incentive, and I don't know that they are necessarily possible to be changed. So I would not confuse goals and tools here.
Thank you. There are a few questions around, well, people are asking for examples of institutional asset owners who successfully, that's a hard word, manage systemic risk and impact. Does it work given the gaps that you've highlighted? How do we accelerate corporate consideration of inequality without the specter of regulation?
That's a whole other talk I give. I just spoke to the Australian Institute about what the reaction to systems level investing has been since the book came out 2 years ago. I think there are several. The University Pension Plan in Ontario, which is a $12 billion pension plan, puts systems level investing front and center in their statement of investment beliefs, and it is driving their rationalization of investments. I note that there are a number of entities, major entities like Amundi is co-sponsoring shareholder, and HESTA in Australia, and in some cases, I'll leave it there because those I'm sure of are co-sponsoring some of the shareholder commons initiatives around antimicrobial resistance through the food chain and industrial farming. A lot of these issues are systemic within an industry. So, for instance, extractive mining, we're Nordea, we're the Extractive Mining Initiative, and the Church of England Commissioners has been very good. So yeah, there are lots of examples. I'd be glad to. I have a whole different slide deck about it. It is early. I'm actually impressed with how much has been adopted, but we're 2 years in. I think we're about where I would have thought at 5 years, but it's still early.
We need multiple lives, John. There's a question. Yeah, that's interesting. Sounds like some practical empathy is needed around the ESG table. Where within the field can companies and or stewards find those people who are capable of empathy behind you? Let me broaden that question a little bit in the interest of time. If you're an investor today trying to solve any of these issues, and you have a board across the table that you're trying to engage, what are your real tools with the board? If you're, I'm thinking about Exxon and the Exxon story from a couple of years ago, for example, with a few supposedly climate-friendly directors being voted in, or climate-competent directors being voted in. Does that work? And or is this an empathy question?
Any specific situation is going to have specific levers that need to be pulled, and those range from providing information and empathy and trying to capture hearts and minds to pure power, right? And how one chooses power actually is a word we didn't mention. I usually mention it in these talks. How you choose what your targets are, meaning both what your issue and where. Is it broad? Is it a specific company? Is it corporate specific? Is it systemic? Partially depend on the leverage you as an institution have. So for instance, I mentioned the University Pension Plan just because I've been working with them. I know how they're thinking about these things. Their CEO, Barb's Van, is one of the 5 people that Canada is relying on to come up with their climate change policy. And so they feel that they have a way to affect government policy as well as corporate specific situations. So they are also focusing on that. I think it is very much you do sort of a SWOT analysis of your institution, and then you apply that SWOT analysis to the individual situation to try to be most successful in achieving your goal. So I don't think it is a question. I don't think it's a question of empathy and coercion or power. I think it is I have this company, I have this situation, I have these levers. What has the biggest chance of getting me to what I want to achieve? In the Exxon situation, I think it's an interesting question as to how many directors. I do think Engine One made a number of people sit up and take notice. I do not know what if anything Exxon has done since then. It is still a minority of of directors. But I do know, for instance, I've spoken to Karina Litvak, who many on this call will know. She is a longtime ICGM member who is finishing, I believe, an 8-year term on the board of Eni, the Italian oil and gas company. And she will tell you that she has helped to move them towards, they're still a fossil fuel company, but move them to setting themselves up to be a successful energy renewable company in the future, by providing all sorts of IEA analyses, CapEx analyses, discount rates for carbon, scenario tests, and just relentlessly asking the C-suite to say, what's your reaction to this? What's your reaction if the discount rate is X versus Y? What's your reaction if the curve looks like this instead of that? And they have, so that's the other way. Get someone really good elected to the board. It can matter.
It makes a lot of sense. Let me ask a last question in closing, since we're at time, and maybe that opens to your closing comments. And again, apologies if I did not get to your question in our limited time here. Here's a fundamental question. Do you get a sense that both investors, or either investors and corporates, want to mitigate the gaps that you've highlighted? Is the call coming more strongly from one side than the other? Should we mitigate this gap?
I think right now, corporates are feeling look, to talk about it, all investors or all corporates is a fool's errand, right? So let me just say upfront, we're all heterogeneous. Having said that, my impression, particularly in the United States, is that a lot of corporations feel under attack in terms of having to pick political sides around ESG. At the same time, they all actually understand the value of ESG issues. I'll take one. My favorite is the Koch brothers, which is, the right wing fund everything, and a political and a private entity. So you can't blame this on investor pressure or anything else. You read their DEI policies, and they're like, New York City could have drafted them, right? And so the value of a lot of ESG is being recognized, at least on the ESG integration side, if not on the impact side, by a host of companies who are actually upset that they have. Believe me, Disney would prefer not to be in the middle of things. And so what they, I think they would like to find a way out of the political spotlight, or perhaps the political fire zone, actually. And to the extent, and it may be an opportunity in some ways for investors to make common cause around certain issues, because the right-wing attack on ESG is not perceived, I don't think, by most of corporate America as being done to maximize either portfolio or corporate value. It is being done to carry forth a political agenda. And so I do think at the moment there is, perversely, at the moment that's most frustrating, a unique opportunity to make common cause with a lot of the largest companies in America. Now, not around everything. We've seen, anti-union and anti-lobbying, right to associate situations at some, but at others, I think there may be an opportunity.
Well, John, may you be right. Thank you so much for taking this hour off of your birthday to share your thoughts. Thanks everyone for joining and for your questions. This talk will be uploaded to YouTube in a little while, once we figure out how to do it, because I have to relearn it every time. John, a last question from me. Do you have a birthday lunch ahead of you?
No, I have birthday dinner though.
You have a birthday dinner. Okay. Well, thanks again. Happy birthday. And everyone, see you in our next adventures.
Take care.